The role of central banks in managing inflation. What's inflation? Inflation refers to the rate at which the general level of prices for goods and services rises over time. It's measured by indices such as the Consumer Price Index or the Producer Price Index. Inflation is crucial to the economy because it affects the purchasing power of consumers and the cost of doing business. If inflation is too high, money loses its value and people can afford fewer goods and services. On the other hand, if inflation is too low, it can signal weak demand and economic stagnation. Maintaining a stable inflation rate is therefore one of the central bank's primary objectives to ensure sustainable economic growth. The central bank's role in inflation management. Central banks are responsible for formulating and implementing monetary policy to control inflation. Their role includes adjusting interest rates, managing the money supply, and using other financial instruments to influence demand and supply in the economy. The central bank aims to stabilize inflation by keeping it within a target range typically set by the government or the central bank itself, which is often around 2% in many advanced economies. By doing so, central banks help create a stable economic environment conducive to growth, investment, and job creation. Tools used by central banks to manage inflation. To control inflation, central banks use a variety of tools. The most common and effective tools include interest rates or monetary policy. One of the most powerful tools central banks have is adjusting interest rates. When inflation is high, central banks may raise interest rates to reduce borrowing and spending, which helps slow down the economy and lowers inflation. Conversely, when inflation is low, central banks may lower interest rates to encourage borrowing, spending, and investment, which can stimulate economic activity and prevent deflation. Open market operations, or OMOs. Central banks also engage in open market operations where they buy or sell government bonds to control the money supply. By selling bonds, they reduce the amount of money circulating in the economy, helping to reduce inflation. On the other hand, by buying bonds, central banks inject money into the economy, potentially stimulating inflation. Reserve requirements. Another tool central banks use is adjusting the reserve requirement, which is the amount of money that commercial banks are required to hold in reserve. By increasing the reserve requirement, central banks reduce the amount of money available for lending, thus reducing inflationary pressures. Conversely, lowering the reserve requirement can stimulate lending and spending, increasing inflation. Quantitative easing, or QE. This is a more unconventional tool used when interest rates are already low and the central bank needs to inject additional liquidity into the economy. QE involves the central bank purchasing financial assets such as government bonds or mortgage-backed securities to increase the money supply and lower long-term interest rates. Inflation targeting as a policy framework. Many central banks follow an inflation targeting framework, which involves setting a specific target for inflation and using monetary policy tools to achieve that target. The idea behind inflation targeting is to provide clear guidance to the public, businesses, and financial markets about the central bank's commitment to maintaining stable prices. A typical target range might be 2% annual inflation, as this is seen as low enough to avoid the harmful effects of inflation while still allowing for economic growth. Central banks aim to anchor inflation expectations, which in turn helps to keep actual inflation within the desired range. The relationship between interest rates and inflation. Interest rates have a direct and significant impact on inflation. When central banks raise interest rates, borrowing becomes more expensive, which reduces consumer spending and business investment. This leads to lower demand for goods and services, helping to cool inflation. Higher interest rates also incentivize saving, which reduces the amount of money circulating in the economy. Conversely, when central banks lower interest rates, borrowing becomes cheaper, encouraging spending and investment, which can boost economic activity and increase inflation. The challenge of balancing inflation and economic growth. One of the biggest challenges central banks face is striking a balance between controlling inflation and fostering economic growth. If inflation is too high, the central bank must act to bring it down, which can slow economic growth. However, if inflation is kept too low, it may signal weak demand and sluggish economic activity. Central banks must carefully adjust monetary policy to avoid triggering a recession while maintaining price stability. The impact of inflation expectations on policy decisions. Inflation expectations play a critical role in the central bank's ability to manage inflation. If businesses and consumers expect prices to rise in the future, they may adjust their behavior by increasing prices and wages, which can create a self-fulfilling cycle of inflation. Central banks work to manage these expectations by clearly communicating their inflation targets and policy actions. Credible communication from the central bank can help anchor expectations and reduce the likelihood of inflation spiraling out of control. The limitations of central bank policies in controlling inflation. While central banks have powerful tools at their disposal, they are not always able to control inflation effectively. External factors such as global commodity prices, supply chain disruptions, geopolitical events, and natural disasters can push prices higher, making it difficult for central banks to manage inflation solely through monetary policy. For example, a sharp rise in oil prices can increase production costs across the economy, leading to higher prices regardless of interest rates. Hyperinflation and its causes. Hyperinflation is an extreme form of inflation where prices increase uncontrollably, often by several hundred or 1,000% per year. It typically occurs when a government prints excessive amounts of money to finance deficits, leading to a loss of confidence in the currency. Central banks play a crucial role in preventing hyperinflation by maintaining a stable money supply and avoiding excessive government intervention. Countries like Zimbabwe, Venezuela, and Weimar Germany have experienced hyperinflation due to poor monetary policies and political instability. The role of central banks in fighting deflation. When central banks are focused on controlling inflation, they must be mindful of the danger of deflation or falling prices, which can result in lower economic output, higher unemployment, and increased debt burdens. Central banks use monetary policy tools to combat deflation by encouraging spending and investment, lowering interest rates, engaging in quantitative easing, and ensuring ample liquidity in the financial system are all ways central banks work to prevent deflation from taking hold. The global nature of inflation management. Inflation management is not solely a domestic concern. Global factors can also impact a country's inflation rate. Central banks must consider international economic conditions such as exchange rates, global trade, and foreign investment as they affect domestic inflation. For example, an increase in global commodity prices or a decline in the value of a country's currency can lead to higher import prices, which contribute to inflation. Central banks must therefore coordinate with other central banks and international financial institutions to manage inflation effectively in a global interconnected economy. Inflation in developing versus developed economies. The role of central banks in managing inflation may vary between developing and developed economies. In developing countries, central banks often face additional challenges such as political instability, weak institutions, and less effective monetary policies. Inflation can be more volatile in these economies due to external shocks or domestic fiscal imbalances. In developed countries, central banks generally have more credibility and more advanced tools to manage inflation. However, even in developed economies, inflation can still rise unexpectedly due to global factors like oil prices or financial crises. The future of inflation control. The future of inflation management may involve new and innovative approaches, especially in the context of digital currencies and new financial technologies. Central banks are exploring potential for central bank digital currencies, which could provide them with more precise control over money supply and interest rates. Additionally, technological advances in financial systems, data analytics, and global connectivity could help central banks more accurately predict inflation trends and respond faster to economic changes.